While most dividend stocks pay dividends quarterly, there are a select few companies out there that pay dividends monthly as opposed to quarterly. For dividend investors looking for passive income, these stocks are oftentimes more sought out for several reasons. Since our living expenses like rent and energy bills come monthly, receiving dividends every month is much more ideal for people who want to live off their dividend income. Another reason to prefer monthly dividends is faster compounding. When you reinvest those dividends in order to buy more shares, you're receiving more and more dividends every single month. So it's for these reasons that many investors, including myself, are more partial to these kinds of stocks. As of the making of this video, I was able to find about 41 monthly dividend companies. I've seen lists online that claim that there's about 50, but I've checked these lists, and after going through every single company, I discovered that a number of these stocks stopped paying monthly dividends during the pandemic. Some even switched to quarterly after being monthly payers for years. So in today's video, I'm going to be presenting 4 of my current favorite monthly dividend stocks and briefly discuss each of them. These aren't in any particular order like my least to most favorite or anything like that. This list also only covers individual companies and not ETFs. Also, if you're interested in any of these companies, be sure to perform your own due diligence. Going really in-depth on each company here would have taken a really long time to do, so I'm not going to go too deep on each one. For those of you who are new to my channel, my name is Alan, and Dividend Bull focuses on aggressive dividend investing. We don't like to waste our time here with dividend stocks that yield 1 or 2%. Those aren't going to give us enough cash flow to live off of unless we happen to have millions of dollars to invest already. We're also not interested in waiting 30 years for these low-yielding stocks to grow their dividends. We're all about seeking higher-paying dividend stocks now without foregoing safety. If that sounds like something you're interested in, feel free to click the subscribe button below for more dividend investing content. You can also click the bell icon, which gives you an alert as to whenever a new video is posted. Thank you all so much for your consideration, and with that being said, let's get started. The first company stock we're going to take a look at is Stag Industrial, ticker symbol STAG. Stag Industrial is a real estate investment trust that's focused on the acquisition and operation of single-tenant industrial properties throughout the United States. They're the only pure-play industrial REIT active across the entire domestic industrial real estate market. They were founded back in 2010 and they're headquartered in Boston, Massachusetts. I've mentioned this stock a couple of times on my channel before because in my opinion they're one of the best warehouse REITs currently out there. Stag Industrial is a REIT that owns warehouses and distribution centers for a lot of larger companies, including Amazon, which makes up about 40% of their company's portfolio. They also own warehouses for really good tenants like UPS, FedEx, Tesla, Samsung, and Starbucks. According to their latest investor presentation, their property portfolio covers over 60 markets and they own warehouses for companies in over 45 different industries. Some other good things include 40% of their properties deal with e-commerce activity, which is projected to keep growing into the future. Stag also has a lot of long-term lease agreements with the businesses that rent their warehouses. In my opinion, there's a lot of safety in this stock in the sense that the majority of e-commerce tenants like Amazon tend to still do well during bad economic times. Their stock currently yields 3.87%, which is the lowest yielding stock on this list, but that's due to the fact that their share price has seen some massive growth. It's up about 33% from this time a year ago, and it's up over 211% from this time 10 years ago. Stag pays a monthly dividend of a little over 12 cents per share, and they've increased their dividend every single year since their inception, which is really impressive for people who are interested in growth. Stock number 2 on this list is Main Street Capital, ticker symbol MAIN. This is a BDC or a business development company that specializes in supplying equity capital to lower middle market companies. Main Street provides debt capital to middle market companies for acquisitions, management buyouts, growth financings, recapitalizations, and refinancing. They were founded back in 2007 and they're based out of Houston, Texas. Investing in BDCs are in some ways like investing in venture capital funds, only you don't have to be an accredited investor. Companies like Main Street Capital lend money to small and medium-sized businesses who need money in order to grow their companies. As a result, investing in BDCs are considered riskier investments than REITs, and bad economic times can put a lot of stress on BDCs since a lot of companies can go bankrupt during recessions. But there are a few BDCs out there that have distinguished themselves among others. For one thing, Main Street Capital was founded in 2007, right before the financial crisis of 2008. They also survived the pandemic, all without cutting their dividend once. That's a pretty impressive feat that not too many BDCs can achieve. When investing in a BDC, another really important thing to consider is the company's strength in numbers. Main Street is one of the most well-diversified BDCs I've ever come across. They're invested in companies across a ton of different industries, everything from IT services to construction to fireworks, swimming pool supplies, and more. If you want to see for yourself the companies Main Street invests in, you can check out their website and check out their portfolio. Main Street stock currently has a dividend yield of 5.99%, and they pay a monthly dividend of a little over 20 cents per share. Their stock is up about 33% from this time a year ago, and it's up an impressive 147% from 10 years ago. It's pretty unusual for a BDC to experience as much growth as Main Street has achieved, which I think further attests to their excellent management team. Coming in at number 3 on this list is a company many people are probably well familiar with already, but I still have to include it on this list, and that's Realty Income, ticker symbol O. Realty Income, aka the Monthly Dividend Company, is a REIT that was founded back in 1969 and was created specifically to provide investors with consistent dividends every month. They own over 6,600 properties in all 50 states, as well as Puerto Rico and the UK. There's really no way anyone can deny how impressive this company is in regards to their monthly dividends. According to their website, they've paid out monthly dividends for 611 consecutive months, and they've also grown their dividend for 95 consecutive quarters. Right now, Realty Income's properties have a 98% occupancy rating, which is really impressive when compared to other REITs out there. If you go to their website, you can see a breakdown of all the different industries they have properties in, which they currently own real estate in 56 different industries. From what I can see, it looks like Realty Income is slowly transitioning away from some industries that tend to be more impacted during recessions and slower economic times. For example, they've been moving away from gyms and entertainment venues, all of which suffered a lot during the pandemic. Since I've covered this company a lot on this channel, I won't go too in-depth here, but it's great just how dedicated Realty Income is to providing monthly growing dividends. It was basically one of the focal points of this company all the way back when they were founded. They're also a dividend aristocrat because of how long they've been able to grow their dividends. Realty Income stock currently has a 4.23% dividend yield, and their share price is up about 13% from a year ago. When looking back 10 years, their share price is up almost 102%. Their current monthly dividend amount is a little under 24 cents a share. Before I get to the last stock on this list, if this video provided you with any sort of benefit, please consider hitting the thumbs up button below and also subscribing to the channel if you want to see more aggressive dividend investing strategy videos. Thank you all so much for your consideration, and with that being said, let's get to the last company. This last company, in my opinion, is the riskiest stock on this list, and that would be Prospect Capital Corporation, ticker symbol PSEC. Prospect Capital is a business development company that seeks to invest between $10 million to $500 million in each company and invest in a wide range of industries, including aerospace, energy, industrial, financial services, as well as retail. They were founded back in 2004 and they're headquartered in New York City. Prospect Capital, in my opinion, is a mixed bag, and in the past on my channel I've voiced my concern over them, so I'll go over some things that I like and some things that concern me about it. One of the best things about this stock is its dividend yield of 8.16%, which is the highest on this list. It's consistently paid out 6 cents per share in dividends over the last several years. However, as you can see, they have had to cut their dividend a couple times over their 14-year history. Out of any other company on this list, Prospect Capital took the biggest hit from the pandemic. They actually recorded negative net income for the year 2020 because of this, although they are projecting to post much better results for 2021. On the other hand, their stock price has recovered a lot and it's currently up about 67% from this time a year ago. I've known that some people also like Oxford Square Capital as well as Armor Realty, but after I spent some time comparing these three companies and thinking which one I'd feel more comfortable investing in, I ultimately went with Prospect Capital because I think they're in a better position out of all of them. While the other two do have slightly better dividend yields, they do have a much greater history of slashing their dividends. Their share price also hasn't done well over the long term, or they're struggling to return to their pre-pandemic price. In my opinion, if you do decide to invest in Prospect Capital, I would do so very strategically. Be on the lookout for dips in their share price, and I'd also plan on choosing to sell my shares if the share price appreciated too much and I felt like it was overvalued. This is a strategy that I've used in the past with Realty Income years ago, where I'd buy and hold, sell my position when I felt like it was overvalued, and then I'd want to re-enter a position after I saw the price depreciate enough. I also wouldn't feel comfortable holding onto this company for years on end without checking on it from time to time. But again, with its massive dividend yield, the larger the reward, the larger the risk. If you're willing to be strategic when it comes to owning Prospect Capital, along with reinvesting those dividends, I think it can potentially be a very profitable investment. Alright everyone, that's going to wrap up today's video. Thank you all so much for watching, I really do appreciate it. If this video benefited you in any sort of way, please click the like button below, and click subscribe if you want to see more dividend investing strategy videos. It would just let me know that there's a sizable enough audience out there who wants this kind of content, and I'll continue to provide you all with that content. Alright everyone, thanks again for watching, and I'll catch you next time. Take care.